And you'll remember that the balance sheet is a statement of financial position designated by the basic accounting equation of assets equaling liabilities plus owner's equity. And we talked about what kinds of assets businesses have. Before we really move too far today, I do want to spend some time and go back and really talk about not only what kinds of assets businesses have, but I want to focus for a few minutes on how we try and value assets or asset valuation. Now, generally speaking, we could probably approach asset valuation in two different ways. We could try and create a value for an asset either on an objective basis or possibly subjectively. A subjective valuation of an asset is really predicated upon a person's interpretation of the facts or their opinion. If you were to take 2 or 3 people and give them the same facts and circumstances and information about the asset of a business, a subjective approach to that asset valuation amongst those people would really probably create 3 completely separate valuations, because each would value that asset or appraise it in a different way. The other approach, an objective approach to the valuation of an asset, is one where, when applying that approach, you could take a multitude of people and, given the facts and circumstances associated with that asset, all of those individuals would come up with exactly the same value. Well, you can see that there are some significant differences between an objective and a subjective approach. And you'll probably understand that generally accepted accounting principles require an objective approach. The reason for that is that if you're going to provide information about a business, and you hope for that information to be comparable to the information provided by other companies through their financial statements, so investors can really do some comparative analysis. The assets on the balance sheet of these different companies really need to be valued in a consistent and common manner. If in fact we have people just kind of putting their own opinions and guesses about how assets should be valued, there won't be any consistency or comparability from one company's asset valuation to another. Instead, it's necessary that we come up with some kind of an objective approach, because that will improve the comparability of that information from one company to another. Another reason why an objective approach is favorable from the standpoint of the accounting profession is that accountants are going to be held liable, as we've discussed previously, if in fact the financial statements are misstated. If an investor invests in the stock of a company and subsequently discovers that the assets were really overvalued because of some optimistic valuation by an individual, and if in fact that stock ultimately becomes worthless, that investor is going to be interested in potentially seeking damages and possibly suing the accountant if in fact they were associated with that asset valuation. The accounting profession would like to establish an objective approach to valuing the asset, such that anyone looking at the same information would come up with exactly the same value, and that's the accepted approach in terms of valuation. The objective approach required under generally accepted accounting principles is based on what we call the historical cost principle. And that is, we will value assets at the price paid upon acquisition, which we'll refer to as their historical cost. Now, let me give you kind of an example of what I mean by that. Let's take a particular hypothetical situation. Let's assume that there is a real estate developer operating a real estate development company, and that this company purchases land for $500,000 in cash in the year 20X1, and they unsuccessfully tried to rezone it for commercial development. Now, maybe it's not obvious to you, but trying to explain why a developer would like to try and rezone property for commercial development is because commercial property is worth more than other uses of property, either for residential or otherwise. So in many cases, developers will buy property and then seek to change the zoning that allows a certain kind of development to enhance the value of the property. In this particular case, they purchased the property for $500,000. Apparently it was zoned for residential or something otherwise. And they've gone to the city council and tried to have it rezoned for commercial, enhancing the value and ultimate income associated with that property. A year later, amazingly, the city council agrees to rezone the property. A year later, the property is rezoned commercial, and the developer gets an appraisal at 1231x2 the year later, and that appraisal values the land at $900,000. My question to you is, at what amount should this land be valued on the developer's December 31st, X2, at the end of the second year, balance sheet? Well, the answer is that if we're going to use an objective approach, and if that objective approach is going to be historical cost, well, even though that property might legitimately be worth $900,000 today, we will value that land on the books of the developer or on their balance sheet at $500,000, a number that everyone can verify was the acquisition price when that property was purchased. Well, this is an objective approach, but one of the problems with this valuation method is that it tends to be a little bit, somewhat irrelevant. I mean, in reality, if these financial statements are really going to be useful to investors, wouldn't it be better if, in fact, we were to show the value of the asset at what its current fair market value is, this $900,000 value? Let's assume for a moment that, in fact, this property was purchased today and then 20 years from now, in fact, the property has appreciated significantly. It's worth maybe $3 or $4 million. If we were to prepare a balance sheet 20 years from now, would we continue to show $500,000 as its historical cost, even though over time the property has seriously appreciated in value? From an accounting standpoint, according to generally accepted accounting principles, the answer is we will show it at $500,000, its original historical cost, which can be objectively determined. Well, in my own personal opinion, this is one of the great flaws that exists relative to generally accepted accounting principles. A trade-off is being made here. The more relevant information 20 years from now is the value of $2 or $3 million. The value 20 years from now when we're preparing the financial statements, not its cost 20 years ago. However, that is the rule that we currently have as far as generally accepted accounting purposes are concerned, and we're trading off information relevancy for this quest for an objective amount. In my opinion, it's one of the great flaws of generally accepted accounting principles. However, it's a flaw that users of these financial statements must deal with. Today, if an investor or potential creditor using financial statements for a company looks at that balance sheet, they must know and understand that the valuations for those assets are older, potentially older, historical costs. If in fact they want current information about the values of assets, they'll have to go out and get their own appraisals or ask the company to supply appraisals. And in fact, many times that does. If in fact a company is applying for a loan today and they want more current valuation than is presented in the basic financial statements, the balance sheet, they may actually go out and get their own appraisal for it. In my own opinion, this again is one of the great flaws of financial accounting. But as long as we understand that is how assets will be valued, we can understand that and hopefully compensate in terms of getting some additional information. Now, one of the things that I do want to point out before I move on is that at the date of purchase, when in fact this real estate developer in 20X1 purchases the land for $500,000, on that particular date, the $500,000 is in fact the fair market value at that date. If in fact you're out there buying land today and you're negotiating for the best possible price, the lowest price you can possibly get for the purchase of a piece of property, and the seller, looking out for their own best interests, the seller of the property is negotiating for the best price or the highest price they can get. If in fact you ultimately come to a negotiated agreement on price, that is the best manifestation of what that property is really worth at that time. My point is that if in fact you have a transaction in which you have an arm's length transaction where both parties to the transaction are negotiating in their own best interests, that not only will the price agreed upon and paid at the time of purchase be its historical cost, but theoretically it is also its market value at the time of purchase. Of course, as years pass, that market value may change and will continue to rely for financial reporting purposes on the historical cost, but at least at the point of purchase or acquisition of an asset, that asset reflects the true market value. As a result of that, I want to come back to my definition of the historical cost principle and really revise it a little bit or add some additional information to it. The historical cost principle is that assets will be valued at the price paid upon acquisition or its historical cost, or the fair market value of the asset upon the time of its acquisition or receipt. Now really, if in fact you have a transaction in which the buyer and seller of an asset are negotiating their best price, those two things are the same. The historical cost is the market price at the date of acquisition. But in some cases, maybe that's not true. Well, in this particular case, how should we value this asset? In fact, this is an exception to the historical cost principle. If in fact we do not have an arm's length transaction, then we may, in this particular case, be able to put aside the historical cost principle and actually rely on some fair market valuation, although this becomes subjective. In that case, we're going to want to be very careful in the value placed on any asset above its historical cost. And we might go out and seek to get some hard information, some blue book information about what a delivery truck is really worth at this point in time, depending upon how old it is. And so the accountant in this case will try and come up with a fair market valuation, but they're going to tend to be fairly conservative. In fact, in the valuation of assets, even though we're going to use the historical cost principle, you may find that there are some exceptions to that. This is as a result of what I'm going to call an attitude of conservatism. An attitude of conservatism means that if we're not quite sure of the value of an asset, if anything, we'd like to be conservative in that valuation. The reason for that should be rather obvious. As an accountant trying to represent the financial position of a business, the last thing we really want to do is overstate the value of assets such that in the future, if in fact those values are determined to be overstated, and we have a lot of unhappy investors because in fact the financial position was much more optimistic than the way it really turned out, you're going to have disappointed investors, which means potential lawsuits against me, the accountant. Well, if anything, we'd like to have, if we're going to have surprises in the future, I suppose what we'd like to have are some happy surprises. If anything, my attitude as an accountant would be I'd like to understate the assets, if anything, so that if there are any surprises in the future, they're positive surprises. And then everybody's happy, and I won't get sued because of some valuation, previous valuation of assets. As a result of this attitude of conservatism, some exceptions exist for the historical cost principle. For example, let's assume that this $500,000 piece of property, real estate, purchased by the developer, that as they're beginning to, they get their permits and start to actually build their commercial office building on this property, and they start to do some excavation, they discover that underneath this property, and they didn't know about it before, there's a toxic waste dump. As a result of this toxic waste dump, the government quarantines the property and actually declares that it can't be used for 1,000 years. In this particular case, this property not only is not worth $900,000, it isn't even worth the amount of $500,000 historical cost associated with the asset. In this particular case, are we going to continue to show the historical cost on the balance sheet of the company? Well, hey, I'm the accountant, and if I'm going to potentially be sued if I overstate the true value of the assets, I'd like to show this value at potentially zero, if in fact it has no value in the immediate future. Under generally accepted accounting principles, if there is substantial and credible evidence that the value of an asset is actually below its historical cost, in many and most cases, we actually, in the accounting profession, under generally accepted accounting principles, will write down or show the reduced value. So we will make exceptions to historical cost if, in fact, the value of the asset is less than that historical cost. Now, before moving on, let me mention just a few other items that I think are important at this time. When we account for assets and value assets, there are two other principles that I want you to be aware of. One is the monetary measurement principle. The monetary measurement principle really is very simple. We are going to measure the value of assets based on historical cost in dollars. We're going to measure it based on the historical cost in U.S. dollars for U.S. companies and financial reporting. Sometimes the most valuable assets of a business are not assets that you can actually place a monetary value on. For example, the competency or attitude of employees might be the most valuable asset of a business. But because that can't really be measured objectively based upon a historical cost in some dollar amount, it will not be reflected as an asset on our balance sheet. The other important concept or principle to remember is referred to as the entity concept. That is this: we are going to include on the balance sheet of a business only the assets owned by that business. He will not show his personal assets on the balance sheet of the company. We're going to separate the business's assets as a separate entity from the assets of the owners. In a corporate form, if we prepare a balance sheet for IBM Corporation, the assets of the owners or the shareholders are not reflected on the balance sheet of IBM.